just so you can see this. Yeah, so here we go. So I should be in the bottom left, and this is the course. Now, this is kind of like the crown jewels of what we teach. So this is the course which contains the most content. You also get 3 one-to-ones with me, 3 hours of one-to-one with me via Zoom, which normally would cost £240. And the course itself is only £299, so very cheap for what you get. And it's broken down into 5 modules. Here are some previous people who've done the course talking about how they enjoyed it. So the first week is about setting up your portfolio. You don't need to do it week by week. I just did it in 5 modules. The second module is about managing and measuring risk. You'll see when I allocate my own portfolio, I always start with risk, and then I work back to the individual funds. Behavioral investing, because the biggest risk to the portfolio is you and your behavior. And then understanding macroeconomic indicators. A big part of what I teach is showing people what to look at and then what it means for your portfolio, because there are thousands of indicators you could look at, but a lot of them just aren't very informative. So which indicators are important? How do you find them? How do you interpret them? And what it means for individual asset classes. And of course, policy, because as we've seen recently, central bank policy is incredibly important when it comes to driving asset prices. And then the last section is, the last module is on asset allocation strategies. So what kind of asset allocation strategies worked in the past, and how do they work? How do they approach asset allocation? And I should say asset allocation is just how much you put into each of the different asset classes. And it's a really important driver of your success as an investor. So yeah, I mean, it gives a fairly good description of what's in the course here. So to find this, just go to pensioncraft.com, register DIY asset allocation course. And there will be a link in the description if you do want to have a look. So yeah, let's start looking at your questions, of which I suspect there are now several. Okay, so let's start. And I should say also, if you super chat, you get pushed to the top of the queue, but you have to pay for that. But if you do, then I'll answer your questions straight away. Okay, so let's start with Will. Do you see the equity market having a second crash to lower than March lows, or just recovery from now? Well, in terms of earnings, I think earnings are set to take a big nosedive. Another nosedive in Q2. We saw in Q1 in the US they went down about 14%, and in Q2 most people think it'll be almost twice that, so maybe 25-30%. So that takes away the kind of support from earnings for the S&P 500 and other indices. Now, obviously the support is now coming from central banks and central bank policy, but also fiscal policy from governments. And that's probably responsible for a lot of the rally that we've seen. So the question I think actually is, when do people start to think this policy isn't enough? I think there are still fundamental problems with the economy. And the next video I'm about to make is about the Great Depression in the 1930s. And what was interesting then is that it was actually a very slow burn. Initially, there was a big sell-off on Black Thursday, but it took, several years for people to realize that this economic data was just terrible. And it kept on being terrible for a very long time. So I think if we carry on getting very bad data, then that's going to be very bad for the equity market. And at some point, people will realize that whatever level of support there is, if there isn't too much earnings growth or no earnings growth, then there's no fundamental support for the market. So, I mean, I think personally, if this goes on, or if there's a second wave of infection, for example, which we're already starting to see in some countries, then, I think it's quite likely that we will go below the levels we saw before. And then there are kind of secondary effects like a credit accident. So if we start to get a very large pickup in default rates, then, despite all of the support, if a company doesn't have revenue, then that's a problem if there's a lack of demand. And a lot of people may become unemployed as the support schemes end, because there's only so much political support for giving handouts to the populace. Plus, there's only so much generosity that some governments can afford. So once that starts to run out, then, we could see the support start to ebb. We could see more layoffs, and then higher unemployment generally is bad for the economy, and it dents sentiment. I mean, it's easy to be optimistic if you're sitting at home drinking beer in your garden, but if you suddenly be made unemployed, suddenly you're not so optimistic or willing to spend. So I think that's the kind of cusp moment when the support goes away, and we'll have to see what happens to the actual epidemiology of this. But that's impossible to predict, obviously. So personally, yes, I think it will get worse before it gets better. In answer to your question, Will. Right, next one. Has your opinion changed about the market rally? If you think it's going to sell off, how far do you think it'll drop? We kind of answered that. I don't want to give a number because I have no idea. But I think we have a long way to go before we get even to the fair price. So let's just have a quick look at FactSet. Let me just show you this on your screen. Right. So you should see this in a moment. Yeah, here we go. So this is the FactSet weekly newsletter that goes out every Friday. So this is their update to their earnings, bottom-up earnings. And if we look at the S&P 500, so let's look at the forward price to earnings ratio. So this is for this. This is trailing, and this is trailing. And this is forward. Here we go. So this is the 10-year trailing, this is a 10-year history of the forward 12-month PE ratio. And it's still expensive. It's come down a bit, so it's just above 21 last Friday. And fair value would be at, so over the 10-year period, would be at around 15. So just to get to fair value would be a significant drop in the S&P 500. So that's why, I just don't see the fundamental support for equity markets unless earnings growth improves. So my view hasn't changed. No, I can't say that it has. So let me just switch back to me. Okay. More and more pro-investors I follow on Twitter are noticing that their Uber drivers and others you'd normally never expect to touch stocks. They're buying airlines and cruises. Yeah, okay. It's funny. If you read Irrational Exuberance by Robert Schiller, he talks about how if your taxi driver is telling you about stocks, that's usually a good time to sell, because everybody thinks it's a sure bet to buy equity, and that's usually a worrying sign. So personally, I think that's pretty worrying if the Uber drivers are telling you about stocks. Oh, we've got a super chat, so I'll go to that. So KK says, "Sir, what do you think about long-term investing in green companies like JLEN, UKW, Trig, NESF, minimum volatility, safe big dividends and room to grow, or ... So, okay, green companies generally, I think, obviously, I kind of like the concept. Certain sectors are obviously going to be good investments too. Certain other sectors, maybe not so much, but things like green energy, particularly storage technology, if you have to store, the difficulty with renewables obviously is things like storing the energy at night. So if you do invest in things like storage technology or companies which produce the storage technology, I think that's an interesting investment. Generally, green companies which produce renewable energy, yeah, I like. What kind of renewables were you thinking of? Is that the kind of thing? But anyway, yeah, I think the dividends are potentially at risk in this kind of environment, but it really depends on what the company is. There are certain sectors which do depend more on growth, whereas things like energy companies are kind of like utilities in the sense that we always need energy. But really it depends on how cyclical the ESG sector is. And just like there are with other investments, there are sectors in ESG. In fact, you can go for ESG sectors in almost any, in almost all of the same sectors as you do for normal companies, except for maybe energy, maybe arms. There are certain sectors you can't go for, but generally you can get the same sectors for ESG. But yeah, I mean, obviously I support completely ESG investment and impact investment. What's interesting actually about impact investment and ESG, a lot of people say that it's a good thing and you should invest in it, but when it comes down to it, there just isn't that level of investment yet. But the way I see that actually is in my video stats. I did a video about impact investing and ethical investing, which got almost no views. Well, not no views, but very few. Whereas if I talk about the housing market, everybody wants to hear about it. So I think that's the kind of double standard. People say they want ethical investing, but the truth is that when it comes down to it, it's just not that popular and people are obsessed about returns. So, but slightly cynical answer. I'm sorry about that. Right, so what are your views on... Okay, here's another one. More and more... Okay, no. Okay, so what are your thoughts on high-yield corporate bonds hedged, please? Thinking about STHS. So I think SDHS is the PIMCO short duration high yield ETF. Am I right? Yes. So let's have a quick look at that. So let's look on Morningstar because that's pretty good. Let me just share my screen again so you can see. Oh dear, don't want to do that. Here we go. So this is PIMCO's short-term high-yield corporate bond UCITS ETF. So I always love to look at these term sheets because I think it teaches you a lot about investments. So let's just go through what it is. So first of all, obviously it's high-yield corporate bonds. So you're taking a lot of credit risk here. And it's short duration, so you're not taking much duration risk. So if you are worried that rates are going to increase, this would be a good choice. Do I think rates are going to increase at the moment? Probably not. So I wouldn't be that worried about duration. The first thing I always look at is the ongoing charge, which for this one is fairly high. It's 0.6%. But generally for high yield, because it's illiquid, you do get high fees. But there are much lower fee high yield funds. I've seen some for as little as 0.2% in the US. So yeah, I think high yield in this environment is slightly worrying because obviously the Fed is buying junk bonds via ETFs, which is unusual to say the least. So that's providing support. But if default rates pick up, the question is, will that keep the spreads tight? Will a certain amount of Fed buying keep the spreads tight? Or will the fundamentals win over the Fed's purchases? That's the real question. So that would be my concern, I guess. So personally, I've kept away from high yield. In fact, I've even kept away from investment grade because I personally think that there may be a pickup in default rates due to what's going on with revenues being cut short and a lack of demand due to people being locked at home. So personally, I wouldn't do this and I wouldn't touch the high yield market. I wouldn't be taking too much risk at the moment, but I am very cautious personally. So yeah, interesting fund, fairly high fee, but I think, interesting nonetheless. If you do want to take credit risk without taking duration risk. But it's certainly not one of the cheapest funds out there. There are probably alternatives which are cheaper. So let's go back to the questions. I've seen your recent dollar cost averaging video, but in light of the current market volatility, this is Peter Bryden, would you advocate dollar cost averaging or investing outright? Great channel, by the way. Thank you very much, Peter. Well, I mean, a lot of people that I speak to are scared in this environment because obviously the economic data has just been abysmal. It continues to be abysmal, and it will be for some time. And a lot of the headlines are quite scary. And just our everyday life is quite scary. You just have to walk out of your front door to see that. So that makes people cautious, and some people cautious. And one way to ensure that you do invest regularly is to approach it like a machine, right? You kind of program yourself to put in drip feeding into a certain portfolio every month, and that ensures that you get exposure to markets, even if you're scared. Kind of like you train Marines, right, to run into gunfire. It takes years of training for them to have the bravery to do that, but it's almost like they become machines. And that's the way you have to think, in a kind of dispassionate and cool way when you invest, and not to become emotional about it. And that's why I like drip feeding, because it is kind of automated, and effectively you're running into enemy fire, as it were, which is what markets sometimes feel like. But I think for the people who are left in cash, who may be sold during at some point in this crisis, I think ultimately it's good to be exposed to markets. And the time in the market is very important. I think that's true. That remains true. So, dollar cost averaging, if you want to overcome your fear of loss, is a good way to get into markets. Plus, if we do get a big sell-off, then lump sum investing would take a hit. But dollar cost averaging, you're going to pick up those good prices as markets fall. So I think at the moment, yeah, it makes as much sense as anything to do dollar cost averaging. Staying in cash is usually, in fact, it's almost always a bad idea. So as long as you don't sell when markets go down, because that's the worst thing you can do. Okay, Mina Sedom says, hi, thanks a lot for the content. Why on Morningstar rating, funds with high Sharpe ratio still have higher risk? Also, are bonds overvalued now, as well as stocks, to be honest? Yeah. Well, let's start with the first thing, which is a Morningstar rating. Now, Morningstar, if you're not aware, let me just share my screen again, just so you can see this. So this is a Morningstar page. And if we go to the risk and rating page, this is still that PIMCO US high yield corporate bond ETF. So the Sharpe ratio for this one is negative, so minus 0.12, because the return over this 3-year period, I guess, has been negative. But I guess the point with their rating is it's an all-in rating. So if they like the manager, and they like the manager's approach to investing, and they like the style of the manager, and the manager's got a very good track record, they'll give the fund a good rating. It may be that the manager's just had a few off years, maybe recently, in which case it could still get a high rating. But I guess the point here is that the Sharpe ratio merely looks at return. So it's a return over a 3-year period divided by the volatility. So if it's either got a low volatility or a high return or both, the Sharpe ratio will be high. The risk-adjusted return will be high. And that doesn't necessarily mean it's a good manager. It just means they could have been lucky, or they bought the right sectors, they were lucky with the sectors. Or it could be that their remit is just to buy a sector which has done well. If you buy utility, and maybe not utility, a tech fund, Well, tech obviously has done well over the last 3 years. So that will have a high Sharpe ratio, but it could be a lousy manager, and it could be that a squirrel would have done just as well over that period. And they wouldn't get a good Morningstar rating, but they'd have a high Sharpe ratio. It's really just a matter of luck for many of the fund managers, and let's face it, for many of the investors. So, yeah, I think that's probably why the two are quite different things. I hope that answers your question, Mina. Oh yes, please do like our like this stream, and subscribe if you do like our content. It's very good. Yes, there are 67 likes already, 68 now. Oh gosh, okay, good. 72 now. Gosh, that is going up quickly. So yes, please do like it, and also with our videos. You know, if you do like them, it makes a massive difference to whether we get recommended to other people. So do like it and recommend it to your friends. You can always share it via social media. There's a kind of share button for every video. Tell your friends about it, argue about it. But generally, I try to make my videos open-ended so that you can make up your own mind. And it should be a kind of thought-provoking content. That's what I'm aiming for anyway. Rather than telling you what I think, I'd like you to tell me what you think. I think that's usually more interesting. Certainly is to me. And the second part of your question was about valuations. Well, bonds are never overvalued. They're always at fair value. All you can really say is that they have low income. So yes, they have low income at the moment because the risk-free rate is very low. And generally, even in credit markets, credit spreads are tight. So even corporate bonds are giving fairly small income compared to historic levels. So yeah, I mean, all you can say is that the income is low. But the reason why you buy bonds isn't to get rich. The reason why you buy government bonds, at least, is to provide some level of safety in your portfolio. That's why you buy them, and as a hedge for your equity. Right. How do you evaluate... oh, I've skipped 1 second. How do you evaluate... Oh, okay. 1 sec. Okay, let me scoot down a bit because you can always ask the question again if you like. I'll go down to the bottom. What do you think are the long-term prospects of the US all-cap market? That's Michael Robinson. So obviously the US has been by far the best performing country over the last decade. So the question, I guess, really is, will that continue? I think a lot of the reason why the US has outperformed, firstly, is that it's very innovative, and the whole culture of America is very geared up to becoming an entrepreneur, but also to get capital to fund your venture projects is a lot easier in America. And there's a whole culture of, if you fail, it's seen as a learning experience, and then you can go off and start another startup. It's not seen as kind of a black mark such that you can never go out and do it again. So I think that's one of the reasons why America's been so successful, because this whole tech ecosystem which it's created depends on that creativity. Also, they've got great universities which kind of churn out graduate students who, highly talented, able, and then can go on and produce these incredible new technologies. So I think the US is probably still in a position to do well over the next decade. So I expect the US will be amongst the best performers over the long term. Oh, we've got another super chat from KK. So let me just switch to that. Most YouTubers are sure that the worst is coming and that they'll buy the deep. At the same time, the people funds are full of cash. Something wrong here, don't you think so? Yeah, I think that. I think that there is worse to come. That's certainly true, in my opinion. Certainly economically. But I think many of the people that are professional investors are having trouble with this rally because they have to justify what they do based on fundamentals. And the only fundamentals which are supportive at the moment are based on government support. So if life support is all that's keeping your patient alive or reasonably well at the moment, then the question is, would you be very keen to take too much risk with that patient? And for most professional investors, I think the answer is no, because the prospects for earnings growth are certainly weaker, much weaker than they were before this crisis. We'll just have to see how much scarring we get, but I think the prospects are much worse than they were. But I think there's something wrong. Yeah, I mean, there's a huge disconnect between the economy and what's going on with equity markets, for example. A lot of new people to investing are obviously going crazy with, I mean, everyone's talking about Robinhood. In terms of the actual trades, in terms of the volume which happens due to Robinhood and other retail investors, the relative flow is fairly small. But I think, for the small illiquid stocks or the bankrupt stocks like Hertz and some of the airlines, it's pretty clear that it's retail flow which is driving those stocks up. And I think that is kind of crazy. It is just gambling. And effectively, it's what Warren Buffett says. The equity market is a mechanism for transferring money from the inpatient to the patient. So I think, those are usually the bond investors. If you buy a bankrupt company and the company liquidates, who gets the money? Well, the money that was given to it by the equity investors will go to the bondholders. So I think that's one of the reasons why it was kind of good that Hertz wasn't allowed to recapitalize, given this crazy rally that we've had. That was quite good to see. Okay, so back to the questions. Right. Raheem says, how many stocks do you personally own, if you don't mind me asking? Would you just own an ETF and dollar cost average? Well, all of my trades are on YouTube, so you can just look at PensionCraft, how I invested 20k. Just Google that and you'll see my latest videos on how I've invested my own money. I've just got three ETFs, and it's Vanguard Global Minimum Volatility. That's 20% of my portfolio. So that's my global equity allocation. I've got 40% in UK long duration government bonds and 40% in US treasuries. That's US government bonds, but sterling hedged because I'm not taking the currency risk. So only 20% equity, 80% government bonds. Very cautious. That's my portfolio. And I never buy single bonds or single equities either, for that matter.
Patreon.
Oh yes, do support us. Yes, so if you like our content and you want to feed me and feed my dog over here, Teddy, please do support us on Patreon, because we rely completely on you for our support. So it just costs $10 a month. You get access to our live Q&A, where there's a much higher chance of you being answered because there are less of you. And you also get access to our Slack channel, and you get access to our now beautifully indexed content where I answer specific questions suggested by members of the community. So you'll get an increasing library of member-only content if you do become a supporter. And as I say, $10 a month, great value. Oh yeah. Right, so back to this. Oh, question from Julian, who promises he's not a gold bug. Okay. Hi Ramin, your thoughts. It may get worse before it gets better. If Vanguard had a physically backed gold ETF, which worsening economic indicators would make you think about buying some gold? I'd already be buying gold, actually, because, I mean, the things which are bad for gold are interest rates, which are large, right? So big interest rates, high interest rates. If you can buy a treasury that gives you 5%, why would you buy gold? it's safer and it's giving you an income. But if interest rates on, or at least yields on government bonds are very low, almost zero, well, there's not such an opportunity cost going for gold where you get no income at all. So that's why I'd certainly consider having gold, particularly as it's a good hedge. The things which do worry me are that the dollar's strong, which is bad for gold. And I guess gold is itself quite volatile and does tend to crash a bit. So I'd be slightly concerned about that. So I wouldn't have a lot of gold, but I'd certainly have some. But unfortunately, with my Vanguard UK account, I can't buy gold. So, hey, I don't have a choice. Okay. So Scott says... Oh, Scott, that's very kind. Scott says, over 300 viewers right now. 360 in fact.
140 likes.
That's crazy for 42k subscriber channel. Bloody well done. Well, thank you very much. That's very kind of you. Oh, and do like the stream, because then even more people will watch and they'll know about the channel. So yeah, 141 likes so far. Please do like, please do subscribe, and obviously that helps us a lot. Okay. Reading aloud. Backtracing with lump sums, Dalio's all-weather outperforms a 60-40 stock bond portfolio, but when dollar cost averaging, the 60-40 does better. Why is this? Oh, okay, so this is when you backtest. So Dalio does better than a 60-40, but not if you dollar cost average. That's kind of interesting. I guess it depends on the crashing behavior of the two portfolios. So if you've got something which tends to crash more, then if you're unlucky with the timing, then you could underperform. So I guess that's what it would be. It would be the crash behavior. So if you've got a big kind of probability or a higher probability of crashing, then lump sum investing is going to get penalized. So maybe that's why. But it'll be to do with the return distributions for those two strategies, 60-40 and all-weather. I suspect that's a difference. I mean, the drift on the two strategies would be comparable, I expect. But still, yeah. Interesting point. I didn't know that. Yeah, reading aloud, that's really interesting. If you do get in touch, tell me where you saw that backtest. Was it portfoliocharts.com? Interested to hear your thoughts about that. Thoughts on the Main Street lending program. Okay, so this is the thing which the Fed has just announced. Yeah, I mean, obviously at this point, any kind of support for the real economy is very important, which is why the Fed's doing it. But of course, the Fed is in a difficult position because if it does end up lending to illiquid entities, then that's a problem because it's not going to get its money back. And the Fed can only lend, it can't give. So it has to get the money back. So the question is, if you're a company that's in trouble, does it really help you to get a loan from the Fed? Or would you be better off just having greater demand for your products? Sometimes a loan isn't going to help. So I think at this point, that's not clear. Will the lending, for more lending, be the solution to the problem? But really what people want is more demand. And that's very difficult to produce because ultimately more loans isn't going to fix the fundamental problem, which is that social distancing and fear are what's holding back activity. The only way to fix that is to take away the cause, which is the virus. So I think that's the difficulty. But hey, support is a good thing. And you've just got to hear Powell talk in any of his presentations to realize how desperate they are to help. So they are literally looking for anything they can do to support the economy. They're clearly very dedicated to that cause. Okay. Would the Federal Reserve pumping money into the economy This is Raheem. Would the Federal Reserve pumping money into the economy impact the UK in any drastic way? Well, yes, oddly enough, it does kind of affect the UK in a couple of ways. I mean, one of the ways is that many investors nowadays can invest all over the world, and any risk assets have benefited from what the Fed's doing. And by risk assets, I mean things like equity, real estate, commercial real estate, corporate bonds, even some currencies are risk currencies like the Australian dollar, like Norwegian kroner. So a lot of these risk assets have benefited, including the ones in the UK. So if anybody has enough wealth in order to invest, then yes, people in the UK have been massively helped by the Fed. But would poor people in the UK be helped by the Fed? No, quite the opposite. And I think that's the terrible thing about stimulus. It disproportionately helps people who are wealthy, and it increases inequality. I mean, you've just got to look at asset prices to see that, right? If you can't afford to buy equity, then what good is reflation of the equity market to you? If you can't afford to buy government bonds, what use is reflation of the government bond market to you? So I think from that point of view, it's kind of bad because it's increased inequality, but I don't think they have a choice. They've got this very blunt set of tools. So they're hoping that by helping the wealthier part of society, they're going to improve life for everybody, or at least soften the blow. That's what they're hoping. And that's helped people all across the world, what the Fed's doing, because they do everything in larger size than everyone else. Okay, so here's a point from... Okay, that's a good point from Mina, which is the Fed can keep printing money till there's a vaccine. Would that mean there'll be no second crash? It really depends on how long it's going to take to have the problem abate, the virus. So obviously the Fed's going to keep accommodative for a long period of time. More longer than we have the crisis. I'm pretty sure that they're going to keep on doing this until there's a clear evidence that people are no longer worried about social distancing, and the economic impacts have reduced hugely, and unemployment's back to more normal levels, which could take some time. It could take years, in fact. But would stop a second crash? Possibly not. Remember that all the way during the crash in 2008, 2009, the Fed kept on coming with scheme after scheme in order to stimulate the economy. Obviously, it cut rates to zero very quickly, but then it took ages for the market to turn around. So I think, we can still get big sell-offs, even with huge accommodation. And I think the other problem is that every time the Fed does something, it becomes less surprising. And even if they up their game, the shock and awe diminishes every time they do something. We saw that with the successive rounds of QE in 2008, 2009. So I think that's the worry, that we're not going to see enough shock and awe, and people will just get almost tired of stimulus, and it'll become less effective as a result. That's my concern. And then we could get a big sell-off, even though the Fed's very accommodative. Because remember, it's not the job of the Fed to put a floor on prices. That's not their job. Their job is to ensure there's liquidity, ensure that there's stability of money, so inflation doesn't get too high, and that there's high employment. Fixing the equity market isn't part of their remit. Right. So Stephen Crouch, what do you think of German DAX unhedged? German economy probably takes less of a hit than UK, and surely the pound is going to dive if we get a no-deal Brexit. A couple of points there. The German economy, I think, is also set to lose quite a lot. Let me just quickly get the IMF. I think it was the OECD coronavirus impacts thing. Let me just show you this. Because I've just been looking at this because I was making a video. So, yeah, let me just see the effect. policies. Here we go. Yeah, so let me just share my screen so you can see this. Otherwise, I've got no idea what I'm talking about. Right, so this is a forecast from the OECD of the GDP impact from COVID. And you can see Germany has a smaller impact, 8.8 if we get a double hit of the virus, 6.6 if we get a single hit, and that's considerably smaller than the UK, Italy and France. Okay, so those are about twice as big, the impacts. So yeah, from that point of view, Germany does look better. I see what you're saying. And yeah, and obviously if you invest in foreign assets and you're a UK investor, then you get benefit if sterling weakens versus a foreign currency like the euro. So if sterling does weaken and Germany does better than the UK, then compared to UK equity, Germany will do better. So yeah, from your point there, yeah, I think Germany would be a better bet than the UK. But the UK is in a particularly difficult position because we have Brexit to contend with. So that's one level of uncertainty with the potential tariffs that could be imposed. Plus we've got COVID to deal with. So that's why, there's a kind of double blow for the UK, which makes the UK instantly at a disadvantage to Germany. Okay. Mixmaster Maverick, interesting point. Do you think there's too much debt in the system? Record mortgage debt, credit card debt, personal loans. How do you see this playing out? Okay, well, the Fed, and if you read these kind of central bank policy notes and you read their risk analyses, then it's very clear that they are concerned about too much debt. And the pockets of debt that we had just before this crisis, a lot of emerging market debt issued by sovereigns, a lot of corporate debt in the US, so leveraged loans in the US. That was a particularly worrisome pocket of high leverage. US corporations had too much leverage. Interestingly, US households didn't because they deleveraged after the global financial crisis slightly. So the pockets of lots of credit are in China, so corporate and domestic in China, and leveraged loans in the US, and emerging market had a very big debt. There's a very good article called Waves of Debt, which I talked about in one of my videos if you look for credit crisis 2020, that's one of the videos I did. You'll see what I think about it. But yeah, I think there is a huge amount of debt. And if you look at the defaults, usually defaults happen when banks tighten credit standards. And again, let me just quickly share my screen. I'm sorry I keep switching back and forth here. Let me just show you what I'm talking about. So this is Fred data. And here I'm going to show you the tightening of credit conditions. So this is from something called the Senior Loan Officers Survey, where the Fed has loan officers at banks. So these are your mom and pop banks across America. And they say to them, look, are you tightening credit standards? Are you making loans harder to get for companies and for corporation and industrial loans? And if so, you go on the positive side of this axis. So positive here means you're tightening, negative means you're loosening. So you can see at the moment there's a great tightening. You see how the curve kind of spikes upward. That's because banks in America are tightening their credit standards when they lend money. And usually that's what happens, if you notice, just before a widening of credit spreads and a sell-off in credit and a recession. So that's certainly happening now. So I think that is a worry. Not only do we have lots of credit out there in America, but elsewhere, but we also have tightening credit standards because banks need to survive, right? They need to protect their balance sheets. And in order to do that, they need to tighten up on their lending standards. So that's a pretty toxic combination for credit. And typically that leads to a credit crisis, or at least a credit widening, credit spread widening, and a sell-off in credit. So, things which are illiquid, highly leveraged are a problem. And the thing which I haven't seen many people talk about this, but peer-to-peer lending, I think, is a particular problem because these are even more junky, a lot of these loans, than junk bonds because they're not even rated and they're even less liquid. If you're lending to a tiny company which can't get a credit rating because it's too small, then they'll be in even more trouble as their revenue falls during the lockdowns than a junk company like Sprint or another one of these kind of low credit quality companies which can issue bonds in the corporate bond market. So that's why I'd be careful about credit in this environment. I think it is a potential bubble which would be popped by this kind of event.
If you want to talk to me one-to-one.
Yes, if you want to talk to me one-to-one, you can organise a power hour. The idea is just go to pensioncraft.com/power-hour, and for £80 you can speak to me one-to-one, or you can do my asset allocation course, and there you get 3 power hours thrown into the course, and you get the course, of course. So yeah, power hours for one-to-one sessions like this, and I'll never give advice because that's not what I'm authorized to do. But I will discuss your portfolio, I'll discuss the risks of certain investments, but I'll never tell you what to do or promote products because that's just not in my interest to do. So that's one of the things you can get if you go to our website, and you'll see the link to the power hours in the description of the video too. Okay. Okay, so Rue Shah. Hi Ramin, greetings. Hello. Which currency does preserve its value best in medium term, 3 to 5 years? On what does the stability of the currency depend? Okay, well, just as you do with risk assets, you can chop up the world of currencies into safe currencies and risky currencies. So the safe haven ones would be the US dollar, the Swiss franc, although the Swiss don't like it, and the Japanese yen, for example. All those 3 would be safe haven currencies. On the risky side is now sterling. Didn't used to be, but it is now a risky currency. It has the volatility of an emerging market, and yeah, it's very choppy, the volatility of sterling. But also the typical ones, which would be the Australian dollar, because it's a commodity currencies. So generally commodity currencies are risky currencies. Commodity currency because they depend on commodity exports for a lot of their income. So the Australian dollar, Norwegian krona was the one I was thinking about earlier. And I'm trying to think of another one, but I can't. Singapore dollar. So that's another one that depends on trade a great deal, very open economy. So all of those are risk currencies. So the ones which are going to lose their value in a crisis are the risky ones, and the ones which will gain in value during a crisis are the safe ones. But if you do think things are going to get better, then I guess things could go in reverse. So it really depends on what you think is going to happen to the global economy. I think that's probably the way I'd think about it. But generally, currencies are much more stable than risk assets like equity or even long-term government bonds, long-duration government bonds. So I wouldn't worry too much about currency if you are a long-term investor. So it depends on economic growth, it depends on interest rates too. But at the moment, it's driven pretty much by risk. And there was an article in the FT today, for example, saying that it's really weird, but equity is now correlated with a lot of currencies, which is very unusual. You don't usually see that. Okay. Hi, Ramin. As a UK investor, is there any reason against investing in US equity since they've been outperforming UK for a while now? No, I don't think there's any kind of problem with it in the sense that the US is so big. The US is very hard to avoid. And if you do buy tech, for example, you're going to have a hard time buying tech if you don't buy US equity. So if you do buy global tracker, it's going to be 55% US anyway. So I think the only reason I'd avoid it is because it's expensive. But personally, I'm not avoiding it at the moment because, I think equity is quite highly correlated at the moment, which usually happens in a crisis. Usually the equity, all equity gets higher correlation between equities during a crisis, and this is no exception. So I think the US is probably, a good region as any. But I'd definitely diversify. I wouldn't just go for one country. I'd definitely split it. And the natural way to do that, the neutral way to do that, if you don't have a view about countries, is just to market cap weight it. Just go for a global index, for example. And that's the neutral, country neutral position. Okay, John Hunt. For a long-term investor, does it make sense now to buy equities even if there's a sell-off? In 10 years' time, won't this be a footnote? Surely cheaper now than in 10 years. What do you think? I agree. I think in 10 years, I think a lot of the effects of what we're seeing now will be forgotten. And I think there will be certain changes in behavior, but I think over a decade, or at least 2 decades, say, this will be a distant memory. It'll just be a blip on a graph. And, people will say, oh, what was that blip? Oh, yeah, it was COVID. Yeah. So I think for a long-term investor, don't stop investing. If you're investing regular monthly amounts, carry on, because equity markets always recover. I wouldn't be taking too much risk. I wouldn't be going for single names, single sectors. Keep it diversified. Keep the allocation in line with your risk profile and your investment horizon, and just stick at it. You don't even need to listen to headlines, or me for that matter. Silly thing for me to say, but I think you can just carry on investing if you are a long-term investor, and you'll probably end up over decades with a very good return, as long as you're not paying too much in fees, right? So 0.2% for your funds, 0.2% for your platform or less. And, oh dear. And startled my dog there. Sorry, Ted. I actually woke him up. I can't believe he doesn't listen to this. He'd be such a good investor and such a good physicist if he listened to all my lessons. But yeah, he's gone back to sleep. Okay, so yeah, I think long-term investors, yeah, just carry on, stick with it. And equity markets always go up over the long term. They always have in the past. Stick with it. Ruchard says, I really appreciate your answer. Thank you. My pleasure. Oh, okay. So let's see if we can get more likes. Yes, we've got 203 likes. So please do like the stream because it helps us a lot if you do. And then I think the algorithm at YouTube knows that what we produce is good, which is always a bonus. So please do like this. Just takes one click from you. And if you're not a subscriber, please do subscribe. We'd appreciate it. And if you're not a Patreon supporter, even better. Plus, remember, if you do become a supporter for $10 a month, you get access to the content which only Patreon supporters get. So that's one of the benefits for you. Obviously, we benefit because we can carry on eating, which is always a benefit. Do you have physics jokes just to mix it up? I wouldn't want to subject you to that. No, I won't do that. Perhaps I should prepare one. Oh, okay, I do know some, but I'm not going to tell you. Good. Okay. What signs would help investors to get back into the market? Well, a couple of things. I think earnings growth is probably the best signal of all, right? So earnings growth has obviously been very weak leading into this crisis. in the US. It was pretty much flat in 2019. Now it's fallen off a cliff, so it's minus 14%. It's going to get worse in Q2. It'll probably be about minus 20. But once that turns around, I think that's a very positive sign, because ultimately it's earnings which drive equity markets up. So your dog must be Warren Buffett. No, he's really not. He's really not. He's fluffy, but he's not Warren Buffett. So yeah, I think that's one of them. Okay, purchasing managers indices, very important too, because that gives you a measure of a kind of almost forward-looking measure of economic activity and whether companies are seeing an improvement. So it's very much up to date because it's published every month. So purchasing managers indices is another. Employment data, critical, but usually that's backward looking. But still, if that starts to improve, the key thing everybody is watching at the moment is how much scarring there's going to be for the unemployment market. So obviously we jumped up to about 14, where it was 17, wasn't it? 17% unemployment in the US. The real number was probably closer to 20 because some people misreported because they were on furlough. And now it's down to 13. But, previously it was like below 4, which is the lowest it's been for 60 years. So the question is, how much scarring is there going to be to the employment market once the forgiveness ends on mortgages, once the payment protection schemes end, and we're kind of back to normal? The economy's opened up again, but there's still a little bit of fear left in the markets. That's the question. Okay, and now let's do how many more questions? Let's do 3 or 4 more questions. Got 450 viewers, that's great. More likes, that's great. 259 likes now, that's very good. If anyone else would like to like it, of the remaining 250 that haven't liked it, please do like it. Let's see if we can get everyone to like it. What's your portfolio? Why is your portfolio weighted so strongly towards bonds? I thought common view was equities beat bonds over 5+ years. Yeah, well, you can see, right? I'm old, and I'm kind of cautious. So if you're 20, that would make no sense at all. But that's why I always say in my videos, don't do what I do, because what's appropriate for me will not be appropriate for you. And I'm just a cautious person by nature. So that's why I'm being so careful. And personally, my view is, which may be different to yours, I hope it's different to yours, is that things are going to get worse before they get better. So there will be a better entry point, I think. Certainly not there yet. And valuations are still very, very, very high relative to earnings. So as a combination of factors, that makes it very unappealing for me to invest. Okay, Sid D. Banzal 07 says, would you combine Vanguard Life Strategy 80 with Vanguard FTSE Global All Cap? Probably not, because those two will be highly correlated. Remember that Vanguard Life Strategy 80 is 80% equity, and FTSE Global All Cap will be 100% equity, obviously, but there'll be a very high correlation between those two. So from a diversification perspective, that doesn't make a lot of sense. So plus, if that's all you've got in your portfolio, you really needn't bother with the global all cap, because it doesn't provide a regional tilt, because it's global. Maybe it provides a very slight small cap tilt, because it's got small caps in it. But, I probably wouldn't bother with both. I don't think. Raphael, interesting point. Once earnings recover, equities will already be expensive, hence buy on fear. Yeah. But the thing is, at the moment, valuations are just so high that equities are already incredibly expensive relative to earnings. So, yeah. I think if there was fear, and the fact is there is very little fear in the markets at the moment. So I think at the moment, I can't see a lot of good reason to buy. Is there a limit to how much? So this is Bumble Buoy. Hi Ramin, is there a limit to how much the government can implement quantitative easing? And what do you think the long-term impact will be? Yeah, there is a limit because their debt to GDP, certainly the central banks, they don't want to have too much of a large balance sheet. Because remember, they have to get out of these positions at some point as well. And so if you have a huge proportion of the government bonds, I mean, that would be the limit, right? You can't buy all of the government bonds. So there is a natural cap, but that would be a crazily high amount of debt to buy. Usually we don't even get near that. But the government, the central banks have to think about their exit plan. And they've got to think, well, at some point we have to get out of this. So what the Fed's doing, which is really smart, is they said, look, this is how much we can buy every month, maximum. This is where we are now. But look, if we needed to, we could really ramp things up. So just by signaling that they can do 10 times as much if they wanted to, that's enough to steady markets. Just thinking that they can do more if they need to. So I think, if they're smart about it, they don't actually have to buy that much to create the kind of soothe people's nerves and to calm markets. Okay, how are we doing? It's 8 o'clock, so I have one more question. See if we can get some more likes. We've got 282. See if we can get it up to 300. So one more question. What about Fundsmith Equity and Lindsell Train Global Funds? Well, I actually did a video about this. So let's just go to that video slides. Now, the name of the video was Strategies, Best Strategy 2020. Let me just share my screen so you can see this too. Okay, so let's go to these charts. So what I did was I looked at passive performers, which were very good. So what's really interesting is, I don't know if you can see this, but anything which tracked tech in the US has done extremely well. And if you track it in sterling, you did even better because sterling has weakened over the last decade. So this is returns from 2011 to 2020. So it's over a period of about 9, almost 10 years. So these are fairly low risk, but very high return. And those really stand out. Just simple NASDAQ trackers, which cost you very little, like 0.3% in management fee. Now you compare that with the active outperformers and things like Fundsmith Equity. Obviously it's done well. That's partly because it was in foreign currency, so it benefited from the currency, just like those NASDAQ trackers. And the same for Lindsell Train, but not as good as Fundsmith. And if you combine the two, you can see that that NASDAQ tracker did better than all of the active funds. So the best performer was a passive fund. And if you look at Fundsmith Equity, it's way down here, right? So these two NASDAQ trackers were far better in terms of return. Slightly higher risk, so about 17%, 17.5% versus Fundsmith, which is like 14 probably. But still, extremely good returns. But of course, for Fundsmith, you'd be paying 3 times as much in terms of fees. Plus, I know the NASDAQ is going to be around in 10 years' time, but will anyone remember Fundsmith in 10 years' time or 20 years' time? Maybe not. So I think, people always look back and say, these are the funds which have done best. There must be geniuses. Well, maybe they were just lucky with the sectors that they chose. They certainly got lucky with the fees that they charged. But yeah, I just don't personally buy into this whole kind of personal culture, this kind of personal cult that's built up around some of these fund managers. I just don't think it's healthy, and I don't think it's warranted. So yeah, they have done well. They're good active funds. Lindsell Train is a lot cheaper than Fundsmith, but hey, I think for most people over the long term, you'd be better off just buying something which has lower fees. and gives you global diversification. And if you do want to get overweight tech or go for a factor fund, you can do that with the proportion of your portfolio. But I just don't buy into active management personally. So anyway, thank you all for your comments and your great questions. Remember, you can get a power hour with me. You can join us on Patreon for $10 a month, and then you get our Sunday evening call, which is much more personal than this. Far fewer people, and you've got much higher chance of getting your question asked. And we've got the course Asset Allocation, which is very good, and you get 3 one-to-one hours with me thrown in for the Asset Allocation course. All of the links to that stuff will be in the description of this video if you want to have a look. And thank you very much for your time. I hope you have a great week, and hopefully I'll see you on Slack when you join us on Patreon. So take care, everyone, and good night.